GridBot earned $6,500 from an initial investment of $1,000 in just over 3 weeks. Let's figure out what it is, what options exist, what settings to apply, which pairs to trade, and how to manage risks. We'll look at all of this in detail. So, here's my GridBot. The one cat pair, which is on the gate with a step of approximately 2.37%. From $1,000, he earned $6,500 in, essentially, today is the 23rd, March 23rd, in 22 days, which is quite an impressive feat to achieve. So, what is a grid bot? What types of grid bots are there? Let's figure it out step by step, what the different options are. So what exactly is a grid bot? A grid bot is a grid-based bot. On the chart, we draw a detailed grid, which serves as a guide for our trading strategy. We trade according to the specific. When we, let's say start with a specific example, such as a classic regular grid bot, which is specifically designed for and aimed at sideways movement, it is commonly referred to as being in a neutral setting. This type of bot is programmed to move laterally, maintaining a balanced and neutral position without any forward or backward bias. So, everything below the midpoint essentially means that the levels that are colored green are the ones where purchases typically occur. Everything above are generally short levels where sales typically occur. For every single buy or sell in the trading system, the take profit is equal to the grid step. If the grid step, that is, the distance from one level to another, is considered to be approximately 1%, then our take profit for both long and short levels will be essentially 1%. In this case, our setting is 3%. So, grid bot options can be entirely short, meaning the entire grid consists of short levels. This means that each level within the grid is designed to be brief and concise. At each and every level we sold, took profit, and then sold again, took profit again, sold, took profit, and so on. When the price is rising, we opened a short position, opened another short position, and then opened another one and another one. Here we didn't reach the level, went slightly down, triggered, and took the profit from this short position. Here again we didn't catch it, went down. Here we didn't open a new one, going down. Nothing happens, we go even lower, another one closes. We have the same for longs. The entire grid consists of long levels, so obviously for a falling market, the short option is the most attractive. For a sideways market or a channel that you want to trade in a sideways movement, neutral is a good option. But it has perhaps the danger or inconvenience that if you move rapidly in one direction, the position will not be particularly desirable. A long grid aimed at bullish growth. This is exactly what suits us today. We expect everything to rise. Maybe not today, maybe not tomorrow, but in the span of 6 months to a year, and definitely in the near future, we expect the market to continue growing. What other deviations exist here? Along with long, neutral, and short grids, there is also a hedge grid, also known as a two-way grid. It is not widely available, but it is indeed very much quite attractive. Its best condition is when the market is moving sideways, so we don't make any unnecessary moves. In fact, we avoid redundant and superfluous actions, certainly. But the mechanics of a hedge grid actually differ from the usual one. In fact, how do they differ? At each level, we open both a long and a short position. That is, in essence, at this particular point in time, we will essentially open both a long and a short. Our long will remain open, our short will close in take profit. Here we will open one more long and one short. The short will remain in the negative, the long will close. So, no matter where the market goes, there's always some action happening. Some of our positions will periodically, constantly, and consistently be closed by take profits, while some positions will remain open. And the next option worth considering is that most grids, which are often observed in financial markets, trade within a specific range or interval and can be influenced by various factors. So, essentially, we are saying that this grid will operate within a relatively small range. As soon as it immediately moves out of the specified predefined range, it stops trading, and either he definitely leaves the existing positions open, or he will undoubtedly close them. This is the stop trigger setting, and the alternative to interval is infinite. Essentially, we just keep drawing our entire grid infinitely both up and down. If the amount of our money is not limited, then in the long run, Hedge Grid on the infinite setting will reassuringly be the most attractive option. Definitely, because the market moves in waves, one way or another, and even if we look back a few years, we have essentially absolutely completed one huge cycle. Some coins have returned to their previous levels, some have grown a bit, and overall the results would have been very, very good indeed. One more point worth mentioning here that is important to note. We just talked about the settings for a futures grid bot. There is an option where we trade a grid bot on the spot market in the cryptocurrency market. It is different, but not fundamentally. The mechanics remain practically the same. The difference is that we don't actually have a hedge row because we can't long and short constantly, at least predictably, and to buy certain volumes of coins that we could then short. And the second option, you can't draw the infinity grid here either, because again, you would need to count all the money in the world to cover it all. But indeed, nothing essentially prevents you from creating the interval extremely large, very high, and trading it all the same, in fact. Spot is attractive for certain situations. It might be slightly less profitable, but nevertheless, with its conservatism, it is also a good option. Suppose you have been consistently investing in Bitcoin and would like to do some trading, but you don't want to sell your Bitcoin. In that case, you can trade spot cross pairs with Bitcoin, like Ether, Bitcoin, or other Bitcoin pairs. And accordingly, as a result of all the trades, you will ultimately always return to Bitcoin. Well, probably the most common example is Ether Bitcoin, which is available on any spot exchange. Next, we can set this to any settings, for example, long. Although, given the current market over the past 2 weeks, a short one should perform better here. On the backtest, but even that is essentially break-even, and the optimal one, well, the optimal one is 15% for us so far, but again, it's short, of course. For that, we would need to short Ether, and with Bitcoin in the current market, well, only 1%. But again, if this definitely becomes a more long-term topic, if we come back here now, then this picture will look completely different. So let's get back to futures. Let's briefly talk about the following. What types of grids are there? We've covered that. How to get started directly, which settings to choose, which pair to trade. Well, for example, here's the popular column on Wonder Trading. They run all pairs through the optimizer on all exchanges and calculate the most optimal settings for each pair based on a backtest over the past 2 weeks. Let's dive deeper into each of these aspects to understand them better. This ensures that you have the best possible settings for trading. For example, we see on Bybit the pair 1000 VEN, and it tells us that if we had traded using the Hedge Grid Bot in this interval with settings of 2% profit per grid, we would have earned almost 1000%. Essentially, we would have earned nearly 1000%. Now, if we look at all this in detail, examining each part closely, maybe zoom in a bit to get a better view, let's switch to a 1-hour time frame to see more specific data and trends. So this is how our performance chart looked indeed, meaning our returns were slow. It rose, then the price started to fall. For us, for hedging, this is an ideal situation. We are still staying in this channel, but we are not taking on extra positions. Then we went down a bit, and our P&L also started to drop. We started to come back, we're coming back. Here we're fully in the channel, everything's going well. And then, when we commence repeating cycles, it takes a good profit, which is beneficial for our overall strategy. Then there was a strong decline again, we are also exiting the channel, and all of this practically came to nothing. So, he had a remarkable period roughly from March 8 to 18, where it was possible to earn over 900%. Then we go to 0 percentages, then we go to 0 and approximately about nearly. And thanks to the fact that we already had some of these positions and didn't reopen them, we kind of returned to this contentedly and with great satisfaction, as in literally 3 to 4 days it returns to its profitability metrics. Wonderful. Similarly, we can take into consideration the behavior of the long grid. Let's optimize the settings for it as well in this context and analyze it in detail. According to Rule 1.37, this applies to our current situation. We will conduct a backtest to analyze the results and see what outcomes we get. We'll remove the extra markings from the chart for better clarity and understanding. On the purely long grid, we also see that the bot earned 750% in 2 weeks. For a long time it was hovering around 0, even collecting some losses. Then it started to grow. Here we had 385%. Not bad. But then when the market fell, it became clear that it was very painful for the long grid. Moreover, it had a drawdown of approximately as much as 60% in the market. And now, let's take a moment to discuss the important topic of risk management in more detail, which is crucial for the stability and success of any business. 60%, we had already made some profit here, which is great, but the downside is that the cumulative P&L was actually minus 1200%. That's quite significant. 2200% on this is quite significant. So, for a fairly volatile pair, 1000 Ven, it is optimal to say that we would have certainly definitely earned with settings of 1.37, but the decline in the market was very significant. It's worth thinking about risk management and money management, and whether we could realistically endure all of this, or if we should lower our expectations a bit and set safer parameters. For example, even 3% for such a pair would already be easier. If it had a 60% drawdown, then with a step of 3%, it means we would have collected about 20 levels of pure loss, to be precise. Overall, that doesn't sound too bad, approximately. In total, which is in essence not too bad. Let's dive deeper into what this actually signifies for us and its potential implications. Let's assume that our investment, that is our total deposit on the exchange, amounts to approximately $1,000. The amount we trade, meaning at each and every single level we open a position with an amount of approximately $100 or so. That is, we enter each level with approximately 10% of our initial investment deposit. And our grid step is 3%, which means that for every step, the value changes by 3%. Thus, with 20 levels, which corresponds to a 60% drop in value from the initial point, we would end up accumulating positions worth 2,000 units, while we have only 1,000 units to start with. So this is essentially a leverage of 2x, meaning we are effectively doubling our initial investment. Plus, our financial balance would decrease over time. Why? Because our financial losses grow rapidly and exponentially as we accumulate positions in the market. At the highest levels, the incurred losses are the maximum possible. These losses remain unrealized, meaning they have not. So, for example, it's a job position that was opened at the very top of the channel and went all the way to reach down to its bottom will have almost a 60% loss. The next one with just about a 3% loss will have an approximate total of around a 57% loss. The next value in the sequence will be a decrease of 54%. After that, we sum up all these values to get the final result. In the end, it ultimately results in a rather significant and considerable unrealized loss or deficit. In this particular case, the loss would be approximately around about $630, and we would actually have about approximately $370 left from our balance. And our position, I remind you, is already 2,000 at this point, with 370 remaining, plus the reserves that the exchange holds until liquidation. So, roughly speaking, let's calculate at least approximately to understand. Accordingly, we have leverage here that is already less than tenfold, but still quite significant and noteworthy. This leverage is important. Let's calculate this. We have a leverage of approximately 5.5, considering some significant margin and several additional factors, but let's say we assume that we are indeed already using something like the 7th leverage there. But in reality, to understand, because the liquidation price will be closer, plus it also depends on the pair, the exchange, and the margin settings you have set on the exchange, like isolated, cross, and so on. And so we see that, okay, we somehow managed to get through this whole thing with the drawdown, but essentially, we basically lost the entire deposit. In this case, it all bounced back, and that's kind of great, but it could have continued to fall, and if it had continued to fall, we would have been wiped out pretty soon. This is exactly why it's very important, indeed extremely crucial, to use a stop loss. For instance, if we say that we are trading 10% of the deposit in amount per trade, then it's also very good to use a stop loss around 10% for simple math, which is a key strategy so that it allows us to manage our risk effectively. Our loss in this column is calculated, meaning approximately we would reach. This would allow us, such a stop loss would allow us to reach about the 7th level. And again, we are talking about a continuous drop. If we have already stayed in the channels for a while, or there was at least some growth, then this was already realized profit for this bot. Consequently, it will definitely allow us to have more funds to fall back on later, because the stop loss is set in dollars and it is applied directly to the total P&L. Accordingly, we could have dropped a bit more, but for simple math, this is essentially enough, indeed. There is an alternative option where you don't set a stop loss, and then you just collect everything and wait it out. Overall, this is also an option. It depends on various aspects of psychology, the field of approach, and the overall effective strategy. But suppose you set 9-10 additional specific grid sections, and on each particular grid section, you position a stop loss. The likelihood that all grids will go down equally and close at the stop is not very high overall, generally speaking. Especially if you haven't opened all these grids at the same time, not on the same pair, not on the same exchange, and blah blah blah. All this diversification ultimately helps you withstand much more. Why is it better to set a stop loss at 10, 15, or even 20% of the deposit? Or more precisely, an amount equal to the amount per trade, or double the amount per trade? For example, if we are trading 100, then the stop loss could be $200, just to minimize the risk of being stopped out. It's still definitely better than if we end up losing 70-80% of the deposit or get completely liquidated and lose everything. Better why? Because at this particular moment of such a decline, you might close somewhere approximately around here, wait it out, and then open at the bottom. We've gathered all the positives we have gathered here, so we can now close this grid. So, the long grid is definitely indeed demonstrating excellent performance here. Besides collecting all this profit, we will also be capturing these intra-channel movements. Which pair to choose? Overall, the optimized settings and configurations offered in Popular are generally not bad. In general, what should you pay attention to? Well, for example, a pair that is traded on more than one exchange will obviously, in various ways and to a great extent, be less susceptible to manipulation in a meaningful manner. For example, the VF pair, despite being quite volatile in nature, will be somewhat more protected and therefore more secure than a pair that is traded on only one exchange. Because when a pair is traded only on one exchange, it means that some interested party with significant influence, such as a large wallet, can significantly affect it, potentially crash the price, or pump it, and for the trading grid, this is not a very good scenario at all. For instance, consider the VV pair. It performs exceptionally well, and the optimization analysis clearly shows that you should definitely choose the hedge. If we want to be more cautious and conservative, we can choose to set, for example, the options of classic long or even indefinitely. Let's optimize our step to 1.77, which is a crucial parameter in our strategy. Let's see, there was a significant drop of 40%, followed by another drop of 43%. Overall, it might be better to play it a bit safer and set it to, say, 3% to mitigate risks. In the backtest, we'll see that our profit will naturally decrease because we'll be making fewer trades, which is a trade-off for stability. So, here we have a total of 200 trades, and our total P&L is 287%, which is still a substantial return on investment. If we set, for instance, 1.7, as it was in the backtest, our total P&L becomes 340, which is higher, and the number of trades also increases considerably more as a result of this. But the risks start to grow disproportionately and significantly because, in the event of a significant decline, our overall position on the exchange will be much larger and more impactful. And the likelihood of getting stopped out becomes significantly higher. If we didn't set a stop, the risks of liquidation are also significantly higher. The safer the settings we apply to each individual grid, the more grids we can safely configure and manage effectively, ensuring optimal performance and reliability. And here I want to make one remark, that the total amount of all amount per trade of your open grids should not exceed 10% of your investments. Why? If we, for instance, break this rule and set the amount per trade equal to your deposit, say 1,000, and even if the step remains 3%, in the balance column, we can definitely indeed observe that it diminishes, and generally speaking, by the 8th level, somewhere around the 7th, we will definitely be completely wiped out. Around the 7th level, we will be liquidated on the exchange platform, and even with a grid step of 3%, we can only withstand a price drawdown of approximately 21%. For a volatile pair today, that's nothing at all. Even Bitcoin can drop by 20% quite easily. So the risks are incomparable. If you set it to 5,500, for example, which is definitely half, the situation certainly improves significantly, and you can withstand more, but we advise sticking to the 10% rule and not exceeding it. So, for example, if you want to open one grid, you can open it with approximately $100 if your deposit is essentially 1,000, basically. If you have a deposit of 1,000, you can open 2 grids of $50 each, or 4 grids of 25, or 5 of 20. Basically, you get the math. Regarding profit per grid, the system optimally selects profit per grid to maximize total P&L. Generally speaking, in general, each pair typically moves within its own specific range and within its own range. For example, if we set a 5% grid step on the same currency pair, it will make certain trades. However, there will be significantly fewer of them compared to a smaller grid step. Let's explore this in more detail. With approximately 5%, we will have a total of approximately 78 trades. But if we set it to just 1%, we will have approximately 1327 trades. And so on. But if it's around approximately 10%, for instance, then we will have only 19 trades in total. On almost all exchanges and services that provide GridBot, profit per grid is a field that you can edit yourself. Everyone is essentially pushing you to set the number of levels, but in the grand scheme of things, what difference does it really make how many levels there are in this particular interval, after all? Thus, they divert your attention from an obvious important indicator. Why is it important? For exchanges, it's crucial that you trade, and the more you trade, the better. With a grid step of 1%, especially on a highly volatile and unpredictable pair, as is very often and frequently recommended on major exchanges, it turns out to be a very good strategy for them indeed. 1329 trades in 2 weeks, even with approximately a small amount of money, you'll potentially be paying quite a significant bit in transaction fees. Will you potentially earn anything? Maybe, but the probability that you will lose is quite high. Again, considering the fact that trading with a very small amount per trade so that you don't get wiped out, but having a large deposit is probably not the right approach, because in the end, you still want to calculate your returns directly on the portfolio, meaning how much you actually had. Indeed, in fact, essentially. Returning to my example, 6.5 thousand was earned from 1,000, but 1,000 is the amount per trade, meaning that's how much goes into the trade. Indeed, as we already mentioned, the amount per trade should not exceed approximately 10% of the total deposit, which in this case is 10,000 in total. And the yield for approximately 3 weeks is 6,500. We calculate it not on 1,000 but on 1,000. Thus the results, as expected, ultimately become more modest. Not 650%, but 65% in the end in reality. Nevertheless, 65% in 3 weeks, you must admit, is quite good. But the most important thing is, what are the risks? What if the risks were to lose everything? That's not an interesting game. But in this case, things are actually turning out quite well for us. We talked about various risks, we talked about effective money management strategies, and we also talked about the importance of setting a stop loss. We strictly adhere to the rule, once more approximately 10% of the deposit or an amount equal to the amount to portrait. You can take a small margin of approximately 30%, meaning not roughly 30%, but for example, if the amount to portrait is around $20, you can set the stop loss not at 20, but at approximately 30 or 40. However, it should not exceed, say, 20% of the deposit as a stop loss, or again use it as an amount. A portrait, but with a coefficient, and this coefficient can be equal to 1 or equal to 1.52, but no more than that. Well, I guess that's all the main points we needed to cover in our detailed and comprehensive discussion. I sincerely wish you great success. Always make sure to start with demo trading. On Wonder Trading, you can indeed easily create a demo trading account completely free of charge. You get 10,000 on any exchange platform you choose. Try as many different grids as you like on various platforms and experiment with different strategies. You trade, try different settings, leave them for a week, 2, 3 weeks, a month, set up 10 grids, leave them for a month, see the results, which settings withstood the market, which didn't, how much, where, what the returns are. After doing this iteration several times over, you will come to understand which specific settings work best for you, for your particular appetite, profitability, your overall sense of risk, and overall, everything will eventually work out. And then you can definitely move on to real money. Good luck, take care.